Hello, everyone. Every analyst on Wall Street is talking about silver going to $100. The confident ones say $150. The bold ones stretch it to $200 and present it as if they are revealing some hidden treasure map. They say it slowly, almost dramatically, as if $200 is the outer boundary of imagination. But it is not. It is not even close. Because when you actually sit down and do the math, real math, not headline math, not narrative math, not emotional math, you do not stop at $200. You do not stop at $300. You do not even stop at $500. What you discover is convergence. Convergence across inflation metrics, convergence across monetary expansion, convergence across historical gold to silver ratios, convergence across supply deficits, convergence across industrial replacement value. And when five independent methodologies begin pointing toward the same valuation cluster, you are no longer speculating. You are modeling, you are measuring, you are mapping structural repricing potential. Let us begin where all serious commodity valuation must begin. Historical peak adjusted for currency debasement. Silver reached $49.45 per ounce in January 1980. That was during the late stages of the 1970s inflation cycle. Paul Volcker had just begun tightening policy. CPI inflation was running double digits. The Hunt brothers were aggressively accumulating physical supply. The public was losing confidence in fiat purchasing power. Now, fast forward 46 years. The official CPI data from the Bureau of Labor Statistics shows cumulative inflation of roughly 380% from January 1980 to early 2026. That means $1 in 1980 has the purchasing power of roughly $4.80 today. Multiply $49.45 by 4.8, and you get approximately $237 per ounce. That alone invalidates the $100 narrative. But CPI is only one lens. Inflation measurement methodology changed repeatedly in the 1990s. Housing calculations shifted from actual purchase price weighting to owner-equivalent rent modeling. Substitution adjustments were introduced, assuming consumers downgrade purchases when prices rise. Hedonic adjustments were layered in to reduce measured inflation when products improved in quality. Many independent economists argue that these adjustments systematically understate real purchasing power erosion. Alternative inflation reconstructions using pre-1990 methodology suggest cumulative inflation closer to 900% to 1,000% since 1980. Using a 1,000% multiplier, $49.45 becomes roughly $544 per ounce. Now, silver is no longer a $200 story. It is already a $500 story. But inflation adjustment alone does not capture monetary debasement. In 1980, US M2 money supply was approximately $1.5 trillion. Today, it stands near $21 trillion. That is a 14-fold expansion. If silver merely tracked monetary base expansion instead of CPI, $50 multiplied by 14 equals $700 per ounce. And that does not include forward expansion. Since 2020 alone, trillions were added to the balance sheet. Fiscal deficits remain persistent. Debt to GDP remains elevated. Structural deficits require ongoing issuance. Monetary expansion is not over. If M2 expands another 20% over the next several years, that $700 baseline becomes $840 without any speculative premium. That is methodology 1, inflation plus monetary expansion. Now methodology 2, the gold-silver ratio. For thousands of years, across empires, across continents, across monetary regimes, silver traded between roughly 12 to 1 and 16 to 1 relative to gold. That ratio was not politically engineered. It reflected geological occurrence ratios and extraction economics. In 1980, when silver peaked at $49.45 and gold approached $850, the ratio compressed to roughly 17 to 1. In 2011, when silver touched $49.82 and gold reached about $1,900, the ratio compressed to roughly 31 to 1. Today, Gold trades near $4,966, while silver trades near $85. That produces a ratio of roughly 58 to 1. Historically elevated. If gold remains flat at $4,966 and the ratio compresses merely to 30 to 1, silver would trade around $165. At 20 to 1, approximately $248. At 15 to 1, around $331. But gold itself may not remain flat. Yardeni Research and other macro analysts have modeled gold scenarios between $8,000 and $10,000 under debt expansion and currency debasement regimes. If gold reaches $8,000 and the ratio compresses to 20 to 1, silver becomes $400. If gold reaches $10,000 and the ratio compresses to 15 to 1, silver becomes roughly $666. At 12 to 1, nearly $833. That is not speculation. That is simple division. And historically, ratio compression accelerates during precious metals bull cycles because silver tends to outperform gold during late-stage monetary stress. That is methodology 2, ratio reversion under gold repricing. Now methodology 3, monetary base coverage modeling. USM2 stands around $21 trillion. In prior metallic monetary systems, paper currency often required 20% to 100% coverage by precious metals. Let us assume a conservative 40% coverage requirement in a partial reset scenario. 40% of $21 trillion equals $8.4 trillion. Global identifiable silver bullion inventories are estimated near 1.5 billion ounces. If silver were allocated $1 trillion of coverage demand, dividing $1 trillion by 1.5 billion ounces produces roughly $666 per ounce. If $1.5 trillion were allocated, silver approaches $1,000 per ounce. Even allocating just $750 billion implies $500 per ounce. Monetary base coverage modeling demonstrates that silver pricing becomes extremely sensitive when coverage demand rises even modestly relative to limited above-ground inventories. Now, methodology 4, structural supply deficit capitalization. The silver market has experienced approximately 100 million ounces of annual deficit for 5 consecutive years. That is roughly 500 million ounces cumulative shortfall. Mine supply growth is constrained. Major new mine development costs range from $500 million to $2 billion and require 10 to 15 years from discovery to production. Typical major mines produce 5 to 20 million ounces annually. To close a 100 million ounce annual gap, you need 5 to 10 large mines at an average cost near $1 billion each. That implies $5 to $10 billion in capital investment. Mining firms require 15% to 20% internal rates of return to deploy capital at scale. At current all-in sustaining costs around $20 per ounce, incentive pricing likely needs to exceed $60 to $80 per ounce just to justify expansion. But commodities in persistent deficit rarely trade at incentive price. They overshoot. During tight cycles, prices can reach 5 times to 10 times production cost. If $80 is required to trigger expansion, scarcity pricing implies $400 to $800 during squeeze conditions. That is not theoretical. That is how capital cycles historically resolve. Now, methodology 5, industrial replacement value. Silver has the highest electrical conductivity of any metal, the highest thermal conductivity, and unique reflectivity and antibacterial properties. It is critical in solar panels, electric vehicles, semiconductors, 5G infrastructure, aerospace systems, medical instruments, and defense electronics. A typical solar panel contains roughly 20 grams of silver, approximately 0.64 ounces. Replacing silver with copper reduces efficiency by 5% to 10%. Over a 25-year panel lifespan, that efficiency loss may equal $75 to $150 in lost electricity output depending on energy pricing. If 0.64 ounces protects $100 in output, that implies $150 per ounce replacement value before redesign costs, certification hurdles, and warranty risks. In military radar systems, satellite communication hardware, and high frequency antenna infrastructure, silver's performance cannot be matched by substitutes without meaningful degradation. In those contexts, price sensitivity collapses. Replacement value becomes secondary to functional necessity. Weighted across applications, industrial modeling supports $400 to $600 valuation under tight supply regimes. Now synthesize all five methodologies. Inflation and money supply expansion support $500 to $700. Ratio compression under gold repricing supports $400 to $800. Monetary base coverage supports $600 to $1,000. Structural deficit capitalization supports $400 to $800. Industrial replacement supports $400 to $600. The clustering midpoint across conservative assumptions converges around $600 to $700. That is baseline structural fair value under current macro conditions without squeeze premium. But markets rarely stop at baseline equilibrium. In 1980, silver overshot by roughly 40%. In 2011, it overshot by roughly 30%. Apply a 30% squeeze premium to a $650 midpoint, and you reach approximately $845. Now incorporate forward monetary expansion. If M2 expands another 20% to 30% over the next several years due to persistent fiscal deficits and structural debt servicing requirements, valuation bands adjust upward proportionally. Apply a 20% forward adjustment to $845 and you approach $1,000. That is how triple-digit upper bands emerge, not from fantasy, from convergence modeling layered with historical overshoot dynamics. Timeline matters. The 1970s precious metals cycle lasted nearly a decade. The 2001 to 2011 bull market lasted 10 years. Commodity supercycles require narrative shifts, capital rotation, and supply responses. Industrial electrification continues expanding. Solar installation scales annually. EV adoption rises. Defense budgets increase. Above-ground inventories remain finite. Monetary systems remain debt expansion dependent. When industrial scarcity intersects with monetary debasement and ratio compression, repricing accelerates. If those forces stall, pricing consolidates. The valuation is conditional. But the conditional math demonstrates that the $200 narrative is not a ceiling. It is a waypoint. The real structural debate is not whether silver can reach $150. It is whether the next decade reflects monetary restraint or ongoing expansion, fiscal consolidation or persistent deficits, supply growth or structural constraint, gold stagnation or gold repricing. Under debt expansion and ratio compression, upper triple-digit scenarios become mechanical. Under tightening and demand contraction, equilibrium compresses. But when five independent valuation methodologies cluster within the same high range, that cluster deserves attention. Inflation modeling, money supply expansion, gold ratio compression, coverage modeling, deficit capitalization, and industrial replacement all independently suggest that silver's long-term structural potential extends well beyond current consensus. Whether the terminal number resolves at $600, $800, or higher depends on macro alignment. But the mathematics show that the mainstream ceiling may simply be the first visible milestone in a much broader repricing cycle shaped by currency credibility, fiscal sustainability, industrial demand persistence, and capital flow rotation.